In this video, we want to talk about how we might explain the curve, right? How do we actually get the shape that we see? One of the theories that we have is something called the pure expectations theory. This basically says that the shape of the curve depends on what you and I think about future interest rates. Now, if you think about this, it sort of works, right? It says people want to get a certain rate of return. And people say, look, we all want to get a 5% rate of return if we invest in a risk-free asset for 5 years. Well, if that's what investors, in quotes, what investors say they want, that's what the government has to pay. Because if they don't pay the 5%, people won't buy the issue. So they have to pay what investors want. And of course, we know that over time, we expect longer time frames to pay higher rates of returns than shorter term rates. So the shape of the curve typically should be upward sloping, but because expectations change, we can also see some downward sloping or even bow-shaped kinds of yield curves. So first thing we're going to do is we're going to assume that the maturity risk premium is zero. Now, we could complicate the formula we're going to talk about by incorporating the maturity risk premium. But for right now, let's just assume we want to see what expectations do to the yield curve. So if the expectations theory is correct, then we can predict future interest rates by doing a little bit of math and working backwards, if you will. So let's assume that these are the treasury rates that we see today. If you buy a 1-year treasury bond, you would expect to earn 6%, 2 years 6.2, etc. Now, if the pure expectations theory holds, again, this is what we want to get paid. So we want to try to see how can we back out now the maybe other questions, right? So this is what we refer to as spot rates. Today, if you buy a 1-year bond, you earn 6%. If you buy a 2-year bond, you earn 6.2%. Now you can see there is an upward slope here, right? It does have an upward slope. But maybe we want to know, well, what is the interest rate next year, right? Or if in 3 years I want to invest, I want to buy a treasury bond in 3 years. What interest rate would I get if I wait for 3 years and buy a 5-year bond? So we can expand this idea to back out some shorter term and different term kinds of rates. So here's how we would look if we have what they refer to as a 1-year forward rate, right? So we end up say that the spot rate for 1 year was 6%. The spot rate for 2 years was 6.2. The question is, what is next year's 1-year rate? Now the math, obviously we need to incorporate time value. So the 6.2, if you buy it today, you get that for 2 years. That's the exponent there, the 2. Now that has to be equal to 6% plus times whatever this is to get this to equal out, right? So to solve for x, it turns out this is 6.4 and then some decimals percent. So this is what you would expect next year. Let's say you buy a mutual fund, and every year the mutual fund pays you some dividends, and let's say they closely relate to 1-year treasury securities. What rate would you get next year when you receive your money at the end of this year? What rate of return will you get? We can also do this looking forward. Say, hey, a 3-year security 2 years from now. So we want to know what? Here's 2 years. We know that that's 6.2%. We were told that the 5-year is 6.5. So what is the return in between? So the idea here, again, 1.065 to the 5th power, because there's 5 years. 1.602 to the 2nd power, because that's the other number we know. Now we also have 1.x to the 3rd power. So we need to solve, again, for this particular ratio here, right? This formula. But what could be more important to a business is not these 3-year securities 2 years from now. We could also say, well, what is the interest rate here? Well, if we know 6.2, and if we know the 3-year rate, we can solve for this interest rate. If we know the 4-year rate, right, 1.061, this interest to the 4th power, right, and we know the 5th power, we can solve for this one. So the idea here for me, from an investment perspective and from a corporate finance perspective, is to understand what happens to interest rates moving forward on an annual basis. Because every year we gather cash flows. Every year we want to reinvest those cash flows. We know from a previous video that there's something called the yield spread, right? Corporate yield spread. So if this is a treasury bond, 5-year treasury bond, and we're talking about investing in a 5-year corporate bond, what's the difference, right? Well, statistically, we can take some averages. What's the average yield spread over those years? We can then apply it to an investment decision utilizing bonds. So what are the basic conclusions? First of all, we know that there is a maturity risk premium. We should, in a more advanced context, we would deal with that. And again, most evidence supports the view. People want short-term rather than long-term. So again, this maturity risk premium has to be greater than 0. There is a theory referred to as the liquidity preference theory. This, again, basically states that long-term rates are generally higher than short-term rates because people perceive short-term rates as being more liquid, less risky. So there is a liquidity preference. So whatever the expectations theory says, we may need to add something to that based on liquidity preferences. If you think about it, most investors would like to lend money to the government, but they don't want to do it for 30 years. They'd rather do it for 1 year. But the government needs long-term financing. How do they get people to buy 30 years when they only want to buy 1 year? They do it by increasing the return that they pay. Market segmentation can give us some different shapes, if you will. It can give us a bow-shaped or a saucer-shaped kind of a yield curve, depending on the demand for that type of security, right? So if everybody wants to buy long-term bonds, there's a demand for long-term bonds. If the demand goes up, we know the yield goes up, right? So that means that part of the curve is going to be much higher. But what if everybody wants to buy middle term? People don't really want to buy 30-year. They don't really want to buy 2-year. The investing public really wants to buy 15-year. That means the demand for that's going to go up. So if the demand goes up, that means the yield is going to go up. So that means we're going to end up having this slope curve, right? That's going to have a bow in it or a saucer shape. Now, there are other factors that affect interest rates. And these, quite frankly, are very important in our current economy. Federal Reserve policy. The Federal Reserve can implement monetary policy to move interest rates in a certain direction. In a time of very high inflation, the Federal Reserve's policy, their job, quite frankly, is to control that. So if we have very high inflation, that means they haven't been controlling it very well so far. How do we fix that? Right? They can take monetary action to increase interest rates. Now, they say that for them to get rid of inflation, they actually have to have an interest rate. The Federal Reserve policy interest rate, or Fed's fund rate, needs to be greater than the inflation rate. So this implies right now we should have like a 10 or 12% Fed funds rate. That's catastrophic, if you ask me, in the business world. Federal budget deficits and surplus. We have a huge deficit in our federal budget. We have a huge amount of federal debt, right? That has an influence on interest rates, right? People start to worry about getting paid, so it costs more when the government spends more money than they make. That causes a pressure on inflation, and inflation is part of interest rates. International factors certainly have influence. The level of business activity. How is business growing? If gross domestic product is growing very, very quickly, faster than what the supply of the society wants, what does that do? It means what? There's demand for money on business, but there's not supply for people that want to buy that. So that can have, again, influence on interest rates through the inflation number. Again, this is a fairly complex economic topic, and hopefully I've done a little bit of justice, try to explain how things might change in the interest rate world. Look forward to talking to you next time.